Welcome to The Explainer. Today we are digging into a really provocative question from an article in The Atlantic. Is this massive AI boom that we're all watching, is it actually a bubble that's about to pop in a really spectacular way? Okay, let's just start with a number that's almost hard to wrap your head around. $5 trillion. That's the mind-boggling valuation Nvidia hit not too long ago. I mean, we're talking about a company that's basically become a load-bearing wall for the entire global economy. And the scale of this thing, it isn't just financial, it's physical. You've got these gigantic data center campuses just popping up, turning huge swaths of farmland into industrial parks that are so big, you can literally, and I mean literally, see them from space. It's wild. So yeah, that brings us to our first section, the AI gold rush. We're going to try and get a real handle on the breathtaking scale of all the money and energy being poured into artificial intelligence right now. The way the market is concentrated here is just staggering. AI isn't just a part of the economy anymore. In a lot of ways, it's propping up a huge piece of it. Just think about this. Since ChatGPT launched, AI stocks are responsible for 75% of the S&P 500's gains. And get this, AI spending has actually contributed more to US GDP growth recently than all consumer spending combined. The article makes this really powerful analogy. You know how some countries are called petrostates because their whole economy depends on oil? Well, the argument is that the US is kind of becoming an Nvidia state. Our whole economy is getting more and more dependent on this one single hardware giant. Every time they have a strong earnings report, it just digs that dependency in a little deeper. But, and this is a big but, this is where we start to see the first cracks in the foundation. Because even with this incredible tech boom, there are some really troubling signs of a disconnect. The broader economy, well, it doesn't seem to be sharing in all that prosperity. And this really gets to this central puzzle of right now, doesn't it? On one side, you have this absolutely red-hot tech market with these trillion-dollar valuations flying around. But on the other side, you have a shaky, uncertain economy where key signs, things like job openings and manufacturing, they seem to be pointing in the wrong direction. And here's that concern in a single picture. Even as the value of tech companies has just exploded to make up a third of the S&P 500, their actual slice of the net profits from those companies has barely budged. So the investment is absolutely massive, but the profits, they just aren't keeping up. And this is the crucial point, right? All this incredible spending isn't actually translating into sustainable profits. I mean, look at OpenAI. They lost $1 billion more than they even made last year. Microsoft lost over $3 billion on its AI ventures in just one quarter. And for most companies that are actually using AI, a McKinsey report found it had, well, no significant impact on their bottom line. It's this disconnect that has people whispering about a potential bubble. This whole profit problem brings us to the financial machinery behind the boom. And this is where some analysts are starting to see these chilling echoes of 2008. And yeah, that's a crisis that's still pretty fresh in our memories. The challenge here is just immense. Even the biggest tech giants, the ones with enormous cash flows, they still need way more capital for this AI arms race. So it's forcing them to get creative and really complex with how they raise outside money without it looking like debt on their balance sheets. So, okay, here's how it works, and it's a pretty slick piece of financial engineering. First, private equity firms raise a ton of money and they build the data center. Then, a tech giant comes along and agrees to a long-term rental lease. Now, here's the crucial part. Those rental agreements, they get bundled up into securities and sold to investors. So to the tech company, it just looks like a rental expense, but to the outside world, it's a way to hide potentially trillions in debt off the official books. And this is exactly where that comparison to 2008 becomes impossible to ignore. The article points out that bundling these leases into risky tranches uses the exact same logic and even the same language as the subprime mortgage crisis, where really complex debt was repackaged to hide massive systemic risk. Sound familiar? And if that wasn't enough to make you nervous, there's also this weird circular flow of money going on. It seems like the same giant pool of capital is just cycling between the major players. One company invests in another, which then buys products from the first company, and it all just props up everyone's valuations. One software engineer called it a techno-capital hyperobject. Now, it's all legal, but it looks a lot like a house of cards. So, where is all this heading? Well, the article suggests a pretty chilling endgame.
an inevitable disruption, where the outcome is painful for the rest of us, whether the AI boom succeeds or if it fails.
And we're left with these two very different paths that seem to lead to the same disruptive destination. The first path is failure. The bubble pops, the leverage funds collapse, and the damage just spreads through the whole financial system, hitting everyday investors. The second path is success. AI becomes so powerful that it wipes out countless jobs, sending this massive shockwave through the global economy before we can even begin to adapt.
According to the article, this is really the key takeaway. For 2 decades now, Silicon Valley has just chased growth at all costs, and often seems pretty uninterested in the consequences for everyone else. This massive data center build-out is sort of the ultimate expression of that chase, this relentless pursuit of scale, just for the sake of scale.
And so that leaves us with this final, lingering question. Is the very logic that's driving all our technological progress, this relentless push for more and more growth, is it also locking us into a future of painful disruption, no matter which path we end up taking?